Welcome to Economics Binoculars, where we put the fun in fundamentals of economics. Yeah, I know, I'm working on better jokes. Anyway, whether you are a newbie or seasoned pro investor, day trader, or long-term investor, have ever wondered at some point, why and how do stocks move? Sure, it's all about supply and demand. But hold on, there are always stocks available to trade. So why do prices keep bouncing up and down every second? Is the market just a giant casino, or is there actual logic behind it? If you've ever watched your portfolio do the cha-cha and being curious what's really going on, this video is for you. In this video, we're breaking it all down into 3 simple sections. 1. Why do stocks move? 2. What triggers the stock movement? 3. Who decides which way it goes? By the end of this video, you'll have a clearer understanding of how the stock market really works, giving you a fresh perspective and helping you make smarter investment decisions. Without further ado, let's dive in. Alright, let's start with the basics. Yes, supply and demand drive stock prices, but there's something even more important, that is trading volume, the number of shares being bought and sold per order. Think of it like this. Imagine you're at an auction, bidding for a rare collectible, say a vintage Pokemon card. If only 5 people want it, the price might stay low. But if 1,000 people suddenly start bidding, prices skyrocket. Same thing with stocks. If everyone wants in, the price surges. If no one cares, prices drop. Now, let's introduce retail investors. That's regular folks like you and me. And institutional investors, the big dogs, hedge funds, banks, and firms managing billions. Here's the catch. Institutional investors trade in massive volumes. Example time. Let's say you want to buy Apple. Not that Apple. Yep, that Apple. You order to buy 10 shares of Apple for $200. That's cute. But when an institution like BlackRock buys 10 million shares in one go, boom, that moves the market. So when people say stock prices are moving, what they really mean is a lot of shares are being traded, and in large amounts. If only a few shares are traded, prices don't move much. But when major players enter the game, things get interesting. Alright, now that we know stocks move when big money flows in or out, let's talk about what actually triggers that movement. All the factors driving these big money flows can be grouped into 4 main categories. A. General business and economic news. Think economic reports like job numbers, inflation data, GDP growth, consumer spending, retail sales, and manufacturing output. These are the market's mood setters. Political news also plays a big role. Announcements about new government regulations, tax policies, interest rate decisions, or massive infrastructure bills can send stocks soaring or tumbling. Even a hint of recession fears or unexpected shifts in monetary policy can cause big money to move in or out of the market. B. Earnings reports. Every quarter, companies drop their earnings reports and investors watch like hawks. Did they rake in big profits? Stocks shoot up? Did they take a loss? Stocks tumble. And when a giant, like Apple or Amazon, reports earnings, it's not just their stock that moves, it can shake up the entire market. But here's the funny thing. Do you know how many people invest in a stock but never even check when that company's earnings report is coming out? A lot. And here's another twist. Just because a company beats earnings expectations doesn't mean its stock will skyrocket the next day. Same goes for a miss. it doesn't always crash. Sometimes, future guidance matters more than the actual earnings. But then again, even strong guidance doesn't guarantee a surge, and weak guidance doesn't always mean a drop. So, go figure. C. Interest rates enter the Fed, FOMC, bond yields, etc. Ah, the Federal Reserve, the people who decide whether your mortgage payments get more expensive. Interest rates affect stock prices, because when rates go up, borrowing gets expensive, businesses slow down, and stock prices fall. When rates go down, money gets cheap, and stocks rally. Bond yields also matter. When the 10-year Treasury yield rises, investors often pull money out of stocks and into bonds, because bonds are often considered safer returns. D. International political news and geopolitical events. Wars, trade disputes, and even a ship getting stuck in a canal can shake up the market. Remember what happened in 2021 Suez Canal grounding? Looking at you, Ever Given. Also, Middle East tensions almost always drive oil prices higher, which in turn impacts energy stocks and industries that rely heavily on fuel costs. Geopolitical uncertainty can make investors nervous, triggering market swings across multiple sectors. Now, let's answer the big question. Who's really in control? Well, it's a battle between retail investors and institutional investors. And spoiler alert, institutions usually win. First of all, as I mentioned previously, institutions trade in billions, while retail traders handle, well, lunch money by comparison. Again, volume matters. Secondly, while you're slowly typing your cute little order, the hedge funds and banks use AI-powered algorithms that execute trades in milliseconds, way faster than any human could ever react. When institutions decide to sell off stocks, their trading bots can trigger massive transactions at lightning speed, and not even Spider-Man could stop the price dropping. In fact, some of the biggest market crashes in history were sparked by institutional sell-offs and billionaire investors pulling the plug. And just like Uncle Ben told Spider-Man, with great power comes great responsibility. The big players in the game have a duty to help maintain a healthy and stable market. But do they always? Well, that's another question. Retail investors usually lose to institutions, but sometimes they fight back hard. Remember GameStop? Hedge funds shorted it, betting on a drop. But Reddit's Wall Street bets drove the price up, triggering a massive short squeeze. For once, retail traders beat Wall Street. But let's be real, that's rare. Do you think retail investors stand a chance against institutional investors? Have you ever made or lost money on a stock because of breaking news? And most importantly, do you think we'll ever see another GameStop-style short squeeze? Let me know your thoughts in the comments below. And of course, if you enjoyed this video, don't forget to like, share, and subscribe.